Arbor Realty Trust, a REIT that is paying a dividend close to 15%, 14.6%. The price to earnings is about 10, and more importantly, the market cap is around $2.2 billion. Why is this important, that the market cap is $2.2 billion? Well, the size is small. And from this level, you can have a double, an increase in market cap. It may go to 5 billion as long as they keep growing. And the dividend yield from this level can increase more in the future. But if you pay close attention to this dividend yield, around 14%, close to 15%, is quite high compared to other investments. This is a high dividend yield. Now, you have to ask yourself if this dividend is sustainable and if this company can grow more in the future. If you look at the history of this company, back at the past, you can see that from 2010, from today, the stock price has increased by over 400%. Of course, it has some ups and downs, but they kept growing. Now, let's look at the dividend, its history. If you look at Arbor, the dividend yield is around 14.6%. And for the last 5 years, as you can see, the dividend has increased from 40 cents to 43 cents. You better see here. From 2015, the dividend was about 58 cents per share. And then over the years, this dividend has increased by 6%, 16, 46%, 41, so from 58 cents to $1.72. So the dividend more than tripled from 2015 to 2024. And what will happen with the dividend if it can triple again in the next 10 years? From this level, you have a 3x in the dividend yield. And especially at the current stock price, if the dividend goes up 3x, you'll have first 28%, and from 28% it will double again, 56%. So, over the next 10 years, you have the possibility, the dividend, to get to 50% on your investment. And if you think in that way, also the stock price will go up in the next 10 years and your dividend will be quite high. Imagine to have a dividend yield of around 50% after 10 years. That will be quite amazing. Quite amazing. Your return will be the highest and you will never sell this company. Now, you also have to understand how they make money, because maybe the dividend won't go that high and their earnings will improve. You also have to look at the risk side, not only the reward. So you've seen the reward. The dividend can go up a lot, and also the stock price. So to understand this company, you have to look what they do. So as I said at the beginning of this video, they are a nationwide REIT from the US. And they are a direct lender, providing loan origination and servicing for commercial real estate assets. In other words, they provide loans to people to buy a house. Quite easy. And here they have two segments. They invest in a diversified portfolio of assets. And the other segment, they originate, sell, and service financial products. In other words, loans. Now, as long as the demand for housing keeps going up, they will continue to make more money, right? And you have to ask yourself if the demand for housing will get higher and higher in the future. And the answer is yes. Everybody wants to own a house. The problem is the costs. That's why this REIT is here to provide financing. And you can look at some indicators to figure out the demand for future homes. For instance, the pending home sales, an index, which is important. Another index is the mortgage applications. So people who applied to take a mortgage. And you can see in the last years, this index went up quite a lot. The application went up. And this is good because there is demand. People want to own a house, to buy a house. So this is good. Now, about this index pending home sales, those are the contracts that are about to be signed. And as you can see, in the last 2 years or 1 year, it went down. And this is a problem only in the short term, because the demand is there. People want to buy a house, but because of high interest rates, they can't get that loan because they don't have the money, the income, the right income to buy a house, especially at those high prices. So in the long term, the demand is there based on those indices. The only problem they have, of course, is the interest rates. As they are so high, especially right now, they can't afford to buy a house, to take a loan and buy a house. But once they get lower, this demand, the mortgage applications will get approved and they'll be able to buy a house. And when that happens, also Arbor will do well in the future. They'll make more money in interest. They'll be able to pay this high dividend and increase their revenue more in the future. Now, what are the current problems this company is facing? So, if you look at the recent developments during 2024, you can see that they have some debt on their balance sheet. You can better see here. Convertible notes, 200 million. Senior notes, 1.2 billion. Securitized debt, 4.6 billion. So they have a lot of debt. And the problem is, they have to repay it. They have to pay their debt. They have a term limit and they have to pay it. And as you can see, the current rate for some of their notes, the average, is about 4.7%, right? And they have to pay this debt. Now, the problem is, if they don't have enough money to pay this debt with their own cash, they have to issue another debt. So they issue debt to pay their current debt. But what's the problem here? You see those interest rates. Their current debt has an interest rate of 4.7% because they issued this debt in the past when interest rates were lower. But now, as interest rates are higher, when they issue a new debt, a new note, the interest is higher, around 9%. And what does it mean? If they have a higher interest, also their earnings, their final earnings will be affected because their interest expense will get higher. As you can see from 2022, the interest has increased from 500 million to 900 million and 800 million. And this is the problem. If they continue to issue debt at those high rates, and sometimes they are forced because they have a term limit, the interest expense will get higher and their their final earnings will be lower. But this will happen as long as interest rates stay high at this level, around this level. If they get lower, then their future interest on their debt will get lower. And the stock price will do well in the future. Then, another problem with this company is this new equity distribution agreement with JP to sell up 40 million shares of common stock. Well, what does it mean this? Here, you can see the number of shares for Arbor Realty Trust. Just look. In 2019, here, 2019, the number of shares was about 100 million. The next 5 years, this number has doubled to 206 million. What does it mean? Well, you lose in value a lot. Half of your value goes down because there are more shareholders. And when there are more shareholders, when they increase the number of shares, the value is divided by more people and you get less. And this is the main problem. So, they already announced that they'll issue more shares, another 30 million. And this will be bad for past shareholders because the value their current value will be divided by more people, and they will get less. Less in dividends, less in earnings. And this is quite bad. Then, they reduce their balance sheet of portfolio by 10%. This means that interest will get lower on their loans because they make money from originating loans, servicing them, but their important revenue is from interest. But when they reduce their loans on their balance sheet, they get less in interest. And they also have some real estate, but it's a small amount. They sold some assets here. And of course, a good point is that they increase their fee servicing portfolio from 2 billion to 43 billion. This is good, they can make more money. But the major problem with this company, as I said, is about the future debt they are issuing at those high rates and future possible dilution. The more shares they issue, the less you get in value. Imagine they pay 1 billion in dividends. And now they are 200 million shareholders. And next year we'll find out there are 400 million shareholders. That means that 1 billion dividends will be divided by 400, not 200. And it's like your dividend will get cut in half. And this is the problem with dilution. So, as long as you have those high interest rates and future possible dilution, the risk is quite high for this company. Of course, they will continue to make money. The dividend may be increased in the future, but we also have to be aware of those interest rates, for how long they will stay around this level. Because they will be affected. You already seen here that they have to issue new debt at a higher interest rate. And this is a problem. So, if you are planning to invest in this company, right now, especially at those prices, yes, they will continue to make more money, but this dividend is in danger. It might be reduced. So it's up to you how you want to invest in this company. If you like the risk and you are not worried about it, you can take advantage of this investment. If not, wait for a drop in the stock price or find other opportunity. So that's it for this video, and if you have other questions, please let me know in the comments.